Excited to introduce the session that's coming up next here. It's on non-traditional reinsurance, and we have Corey Anger that's moderating. She's the managing director at GC Securities, leading origination and structuring efforts within the capital markets team. In her 19 years in the ILS market, she has worked on cat bond transactions totaling more than $23 billion of risk capital placed for insurers, reinsurers, corporate, and government clients. Take it away, Corey.
Thank you. So appreciate it. It's actually been 25 years. I may have not given her the most up-to-date bio. I guess most people don't want to admit to their age, but I really have been in this space since the infancy of it, so is Marcus as well. I think one of the things that I'm going to do is first just open and discuss some of the attributes of ILS, and then Marcus is going to walk us through a deep understanding of the structures, and then Christensen is going to, Coker is going to talk about regulatory framework and kind of interest in ILS and how it can be adapted in for Canada cedents. So I'm going to start first with just talking about the year overall. Insurance-linked securities had a banner year in 2023 in respect of the amount of activity that we have had. It's the most ever. More sponsors are using insurance-linked securities, and all insurance-linked securities are replicating insurance or reinsurance, but in an investable format, so that an investor can say, I'm going to post collateral and take the risk that the defined insurance or reinsurance event happens. We've had a variety of triggers over the years, and in particular was represented in 2024, indemnity, parametric, industry insured loss indices. And the reasons why I find sponsors, and I do my job globally, for using ILS can vary from additional limit requirements, and that as Canada's experienced, the world has experienced inflation and its effect on the total insured values, and then the incremental risk transfer limit that's needed as a result of having larger exposures, particularly imposed when rating agencies put capital requirements to your probable maximum loss. We've seen that effect over the last 3+ years has been a catalyst for sponsors that may have not utilized the market to turn to the first time. And it may not be as a result of, I need my existing limit to come into the ILS market, but as I'm now expanding the amount of limit that I'm buying, now is the catalyst for it. Other cases can be pricing. Simply the property cat market globally has been very challenging over the last several years, and in particular 2022 and 2023, which had some challenging renewals, and looking for additional capacity providers with different filters, different view of risk, and expanding your pool of capital to take on these insurance and reinsurance risks, and be able to do it in a price-effective way can be another reason that folks come and utilize the market. I do note that there haven't been any Canada-specific entities that have utilized the market yet, and we'll get into that in a little bit. So the first thing that I'm going to do is just give a little bit of landscape. And, in 2023, we had elevated losses, though not as high as we saw between 2020 to 2022, which is one of the reasons why you see in the press with all the insurance and the reinsurance brokers talking about the key January 1 renewals, that they went more organized than they were going from 2022 into 2023. And that's just partly because while we had elevated losses, we didn't have the mega cat loss. Most losses were kind of in the $7.5 billion or less, but we just had a lot of little of them as well. What I wanted to get across on this page is that when we talk about insurance-linked securities, there are different segments or sleeves within that whole product scheme. All of it goes back to the premise of I put capital up and I risk that capital to the insurance or the reinsurance event happening. Catastrophe bonds and collateralized reinsurance, and in aggregate, all three forms, broad forms, are about $100 billion in capital, which is quite remarkable that we have been stable over the last 4 years in that $100 billion, because there are losses being paid out of that capital or being trapped with that capital. So to have $100 billion that can write into each period means that the investor base is coming back and producing more capital to then reinvest into this space. But catastrophe bonds and collateralized reinsurance provide excess of loss coverage, and the sidecar structures are capped quota share structures that are collateralized up to the cap of limit that they're providing. So I wanted to give a little flavor of the different sleeves. Catastrophe bonds get a lot of the headline news. A great site if you want to learn and track activity, artemis.bm, does a good job at covering the space. I regularly follow them, and everybody in the industry that's involved in this follows them. But I also wanted to talk about where this capital is coming from. And it's actually coming from the fixed income markets, which as an insurer and a reinsurer typically are low users of obtaining fixed income capital. And that's simply because whether it's the regulators, the rating agencies, they want policyholder claims to come before any fixed income creditors. So in essence, when you put the policyholders first, it subordinates the capital and makes it more equity-like. So many insurers and reinsurers more heavily use the equity capital market segment and not the fixed income segment. So there's this whole pool of capital. And the fixed income markets are actually larger than the equity markets. That just is untapped. And through the ILS market, you're able to tap it. But they do have behaviors that are different than the traditional insurance or reinsurance market. So this is my schematic on or my graphic on the right-hand side. And if you think about two Jersey barriers that are put up, concrete barriers that are put up down a highway, and you're driving your car through there, how ILS prices is typically barriered between where fixed income capital markets yields and spreads are versus traditional reinsurance pricing. And they can play anywhere between that. So that kind of, sets, they don't really go outside of those two areas. But if I make them highs and lows, this is traditional reinsurance pricing, this is capital markets spreads, then there's an ability for ILS to offer pricing that may be differentiated from the reinsurance pricing because they're still getting more yield than they would if they took that dollar of capital and didn't put it into ILS and put it into a fixed income product. But then alternatively, it can be flipped. Capital market spreads are wider, traditional reinsurance pricing is lower, and so they're going to say, I need more yield to have this be attractive and keep the capital there. So we deal with markets where our markets are reacting maybe to the same events, but maybe reacting with different speed. And so I liken it when you're carrying your suitcases, you're on vacation, you go to the hotel, and you have the choice of going up the handicap ramp or up the stairs. And this is actually a pretty good example of it. I can do it here. The capital markets is more like the steps. We may only have 3 of them or 4 of them, but we're going to get up there really, really quickly. So when they move pricing, they move up rapidly to new pricing levels, but then they come down rapidly to new pricing levels. Whereas the traditional market might be like the handicap ramp, where it's going to take a longer time to get to the peak pricing, and then it's going to take a longer time to come down from the peak pricing. And so timing matters in this product. Many of my clients spend years evaluating the product, maybe before they actually utilize it. Some utilize it very quickly, but it's a constant checking of where the two markets are in evaluating the source of capital. I just also wanted to give a sense of the type of sponsors that are using it. It is a global marketplace. Probably more than 53% of the outstanding cat bonds are coming from insurers. A portion of that's coming from Japanese insurers and Europe insurers. Reinsurers are the next largest segment. I think my percentages are, something has gotten warped because that should be 47% on the insurer, and that's really U.S. insurers, rather than 0.47%. We'll fix that so that if these are circulated out, that we'll get the right numbers. And then what's also interesting is we get a lot of public sector clients. This is sovereigns to insurers of last resort are heavy users of the market. And I have corporates that use the market, so and have done so for many years. The other thing that I thought might be interesting to set the landscape for this conversation is just to talk about the representation of risk in the market. And the most risk that's seated in the market, and this is based on all 144A cat bonds that are currently outstanding as of the end of January. 54% of the expected loss that's seated is exposed to U.S. named storm risk. This is the most prevalent peril in the world that's seated in any type of risk transfer format. So no surprise. Your second is U.S. earthquake, same artifact in the traditional market as well. Now what's interesting is that we do have Canada perils that have been seeded through, particularly like think about reinsurers that want to cover North America earthquake risk. They will cover Canada earthquake risk, and so we have some representation, but I would say relative to the amount of risk that's available, it's probably a lower representation relative to what's in the traditional market. But many risks are taken on, and the latest flavor of risk that's not even in the natural catastrophe type of peril, cyber risk was very popular in the fourth quarter of last year. We had 4 deals done exposed to cyber. One of the reasons why these investors show up and want to participate in this product is that there is lower correlation in the performance of ILS relative to traditional capital markets asset classes. If you go back to March of 2022, when the US Fed started raising interest rates, and radically at the speed that they were raising interest rates, the initial concern in March, so there was an effect on the US stock indices because, wow, we're changing interest rates. Feds don't do great jobs at preventing recession, so they tend to go too far and not move fast enough. And then the next concern is, okay, well, when fixed income rates go up, the valuation of fixed income products goes down unless they're floating rate instruments. So you had a whole knock-on effect. So any people that have significant assets, typically on like the life side where you have long-dated fixed income assets, certainly saw an asset valuation hit. Then, because the US is raising rates faster than other economies around the world, in the summer of 2022, you had a very strong dollar. So if you're thinking about all your different capital markets asset classes that you're investing in, all of a sudden there's this knock-on effect from the causation of, I need to tamper inflation, I'm going to raise interest rates, and then it seeps through all these other classes. What's interesting about ILS is, coincidentally, we can be down at the same time that the stock market is down, but the stock market or general economic effect doesn't cause the wind to blow or the ground to shake. And so that's what investors like about this space. They get an adequate return and they get lower correlation. So this graphic just shows the performance that when you compare it against other segments, it's actually done fairly well with less volatility. You don't see as much chinking up and chinking down that you see in, for instance, looking at the S&P 500. Yes, you get more return, but you're taking more risk and volatility associated with that. Now, the last slide I have before I bring in my colleagues is just wanting to show more interim effect. And you can see in September of 2022, we had ILS valuation down at the same time that the stock market was down. two completely different reasons. In September of 2022, we were worried about Hurricane Ian that was affected Florida, whereas in September of 2022, the Fed announced that they were going to continue to raise interest rates unexpectedly, and all of a sudden there was a whole new knock-on effect of what that meant. So completely different reasons why they were down. And then you can see just the performance versus other places, other, kind of monthly performances. You can see that there's no consistency in how ILS performed versus how the stock market or other segments. So with that, I will pause there. And Marcus, do you want to give us a quick introduction of yourself before we go into the questions I prepared?
Sure, yeah. My name is Marcus Schmutz. I started out my career at Swiss Re in Zurich as a property underwriter, but then pretty quickly moved to New York to join Swiss Re Capital Markets, which is Swiss Re's broker-dealer arranging capital markets transactions, just like Corey just described. And I headed up the team there, the structuring and origination team, similar to Corey's current role, for many years. Afterwards, I switched over to the investor side and for several years worked at a ILS investment fund. And now most recently, for about a year, I've been working with perils, and I'll talk about perils a little bit more later in my slides. So that's my kind of summary. And I was asked to provide sort of an overview of the structure and the trigger types of being used basically for ILS transactions. So that's going to be the next few minutes that I'll be talking about. Now here on this slide, you'll see the basic structural diagram for an ILS transaction. And for the sponsor, really, in a nutshell, it's collateralized reinsurance. Even though it's ultimately a bond, the sponsor at the top has a reinsurance agreement with this red entity in the middle, a special purpose reinsurer. And these special purpose reinsurers these days typically are set up in jurisdictions like Bermuda. I think that's the most popular one because Bermuda is very well suited for insurance risk. There's a lot of not just special purpose reinsurers there, but also large global cat reinsurers. So the legal framework and all the infrastructure for administrating insurers and auditors and actuaries and so on, all these services are available, and the legal framework is very well established. So people feel very comfortable with, for instance, Bermuda as a jurisdiction for that. So you have these special purpose reinsurers that's set up specifically for this one transaction. So a company, a primary insurance company will basically cause this special purpose reinsurer to be set up just for their transaction. And nowadays, a special purpose reinsurer can actually host multiple transactions in basically what's called a segregated cell structure. So each cell within this reinsurer could be sort of its own pool of collateral and its own legal entity under the Bermuda insurance regulations, basically. But that's the important thing. So your transaction is only yours, the vehicle is only yours, it doesn't get commingled with risk from any other insurance companies who also access the capital markets. And then the second point is that the contract is fully collateralized. So let's say if the limit of your reinsurance contract is 100 million, there will be 100 million of assets sitting in a trust account, and that's on the left-hand side in this blue box. So typically you have a trustee. If you're a US-based company, for instance, you can have this in a US bank with a US bank as a regular, Reg 114 trust, where basically it follows the US insurance laws for fully collateralized reinsurance, and you get credit for the collateral, basically. And so this collateral is typically in very stable investments. Nobody is interested, neither the sponsor nor the investors are interested in juicing the yield a little bit on these assets, maybe to get more return. They really do not want to take asset risk. The goal of these transactions is really to just transfer insurance risk in its purest form. That's also sometimes I get asked, why don't you just buy shares in a reinsurer if you want exposure to the reinsurance sector? Well, here it's much more pure. It's literally just a very well predefined contract responding only to predefined events, and you don't have any risk for the investment portfolio or the life insurance side or the management or whatever. It's literally just what happens on the claim side in this particular book of business. So now where does the collateral come from? Where did the 100 million come from in this hypothetical contract? That's where the investors come in. So the investors will basically put this 100 million into this special purpose reinsurer as an investment, and the form of the investment is typically a note. So the reinsurer will sell to the investors a note saying, okay, I owe you 100 million. The investors put the 100 million into the special purpose reinsurer, and then basically the conditions of the notes specify that investors are only entitled to a repayment of whatever is left in the trust at the end of the transaction. So if there's claims during the transaction, the collateral will be sold, claims will be paid to the insurance company at the top, and so obviously at the end of the transaction there's not the full amount available to be paid back to the investors. In case of a total loss, there will be nothing left over to be paid to the investors. So the investors really put their capital at risk for a full loss when purchasing this note. In return for doing that, obviously they do get some ongoing payments of premium, so to speak, even though under a note it's called a coupon. So it's basically a regular payment, a quarterly payment of interest under that note. And the source of that interest payment is the reinsurance premium. So the insurance company at the top pays a regular reinsurance premium, just like to any other reinsurer, to the special purpose reinsurer, and special purpose reinsurer passes that on to the investors as part of the coupon. And then the second component of the coupon is whatever return is produced by the collateral. So these treasury money market funds or other securities that sit in the collateral account obviously will also produce some kind of return, and those two combined get passed on to the investors as compensation for taking on the risk to potentially lose their entire investment here. So that's the basic structure. The next one, I think Corey pretty much covered the motivations of sponsors, investors. So for sponsors, it's fully collateralized. I think that is an important point, and maybe we'll get to talk about that a little bit later as well. I think especially if you think about layers that sit very high up in the reinsurance structure, where you think about events that could potentially affect the industry in pretty profound ways, and maybe some of the weaker players may no longer be as viable as they would be under normal circumstances. So having, for really extreme cases, fully collateralized coverage could be valuable to some companies who really want to have a very, very solid reinsurance structure. The other aspect is the multi-year aspect. Now, obviously, there are multi-year contracts in reinsurance, but they are not that common. Reinsurance typically retrades every year, but given the capital markets basically audience of this product, capital markets investors are very used to doing multi-year transactions. Most bonds that are being issued are typically multi-year. So for a sponsor, you can basically lock in your coverage and your price for a multi-year period. And doing that for part of your program obviously provides some stability. You don't have to put everything up for renewal every year and take that off the market for a while, which I think makes potentially your renewal negotiations also a little bit easier. What's the other point I wanted to mention there? So the diversification of capital source, Corey also mentioned. Obviously, having access to different sources of capital gives you more flexibility, and it's obviously a good risk management strategy. The investor segment, I think Corey pretty much covered. It is the fact that these risks are uncorrelated to the capital markets. So for investors who put together portfolios, who try to basically minimize their volatility and maximize the return, like adding an uncorrelated asset to your portfolio will actually help with minimizing the volatility of the portfolio. So that's how investors look at that. Oh, the other point on the multi-year, back to the sponsors, is also there is obviously some cost associated with setting up these transactions. You have to set up these special purpose reinsurer, you have to hire a bunch of service providers, you have to hire a broker dealer to sell the bonds to investors. So by doing multi-year transactions, that allows sponsors to amortize these costs over multiple years and make it more economically feasible, basically. Okay, the next one is trigger mechanisms. So this reinsurance contract that I just talked about, they can have different types of mechanisms under which payments are made to the insurance company. Now, the most common one is on the left-hand side, indemnity, right? So that's how reinsurance typically works. You look at the actual losses of the ceding company, and if they exceed a certain threshold, the deductible, that's when payments start being made, and then at some point at the end of the layer, there's a total loss or a total payment to pay out under the layer. So that's called indemnity because it relates to the ceding company's actual losses. On the extreme other hand, you have parametric type coverages, and these are basically triggered only by the physical parameters of the event. So if you have, for instance, an earthquake, one way to draft or to construct a hypothetical trigger is you have a box around a certain location. If the earthquake is inside the box, there is a payout. If the earthquake is outside the box, there is no payout. And then you can obviously have like multiple boxes with different magnitude thresholds, for instance, to make it a little bit less binary. But it's literally only based on the physical parameters, and these are known very quickly after an event. So you can imagine the earthquake occurring, the USGS or somebody reporting on it, and within a few days, there could potentially be a determination made whether or not this contract triggers, and the payment can be made to the sponsoring company. Whereas on the indemnity side, payments are only made based on paid losses by the ceding company. So it takes a while after a big event, especially if the layer is higher up, for losses to actually get to the attachment point. And then you have all the process around reserves. Are they reasonable? How do they vary over time? So it's a much more protracted process on indemnity. And these contracts, typically indemnity contracts, they have a risk period, which means events are covered during this risk period, but then after that there's also a development period or an extension period where no more new events can trigger a transaction, but you're just waiting for the payments, for the claims payments to catch up, or basically reserves to convert into paid claims, and the uncertainty around the reserves to be reduced to a level where finally you can settle up with investors and everybody's comfortable that the reserves are stable and reasonable. So indemnity triggers are mostly used by primary insurance companies because for them, they don't want to take any uncertainty on the risk, really on the payouts, and also they have pretty transparent books of business. They have policies, pretty straightforward. It's pretty easy to model. It's pretty easy for investors to understand, and so that's why the most common trigger is really indemnity, and the sponsors are these primary insurance companies. The parametric, on the other hand, is typically used by, for instance, disaster relief for countries that have, maybe would be affected if there was a large earthquake, because the government would have to make large payments to help their citizens recover from the event. And so for several countries, we've seen these parametric transactions work very quickly after an event. The payment can then be made to the government of this country that sponsored the bond that can assist then in the disaster relief for these countries. I think the other trigger maybe that I want to talk about, I think I'll skip the model loss, but the industry index, the second one from the right, that one is most commonly used by, I would say, by reinsurers. And what we're talking about here really is the transaction is triggered from an estimate of industry-wide insured losses. And that's the number that you typically hear, right? You hear Ian is a 50 billion event, or some other events. I have some Canadian events later on in some slides that we can talk about. So basically, it's the industry-wide estimate of how much is the insured loss for the industry as a whole. And this type of trigger can make sense for reinsurers because they obviously write multiple ceding companies, and if you kind of aggregate these ceding companies together, you get something that probably correlates pretty well to the industry. And most of these industry triggers also allow for weighting by state, or even further down by CRESTA zones or province or county. So you can really customize it if your book actually does not correspond entirely to the industry. You can weight it more in certain states and certain areas depending on kind of what your book looks like. And the benefit of these triggers is really that it tracks the actual losses for the industry. So after an event, it's not fully deterministic. The magnitude of the event, the path of the hurricane doesn't fully determine what the insured losses are going to be. There is a lot of uncertainty around that. For instance, for a hurricane, like how much storm surge is there? Well, it depends, right? It depends on whether there's a high tide or a low tide. It depends on other things, or in a case of an earthquake, maybe depends on whether it's a very windy day that will encourage larger fire following losses, which typically with a parametric trigger, you couldn't really capture that very well, but an industry trigger will pick all that up. Or if there's increased claims inflation, litigation, things like that, that will all be part of this post-event industry loss. So you're picking up all these kind of uncertainties and reducing kind of the basis risk from these types of factors. So much for the triggers. And now specifically on the industry triggers, so I mentioned I work with Perils, and Perils is one of the organizations that does disseminate these industry triggers. So it was founded in 2009 in Europe. It's a non-for-profit organization, and by now covers 21 countries. And Canada is one of them. In Canada, actually, it's done through CatIQ, which obviously you are very familiar with, attending this conference here. And importantly for industry triggers is obviously the market penetration, right? How are these estimates, these loss estimates developed? You go to seeding companies and they report their losses to Perils, and then Perils basically has to gross those up to make an estimate of how much is the industry as a whole. Typically, you won't get every single company to participate, but your goal is to have a very large percentage of the market participate, so you reduce the uncertainty in extrapolating this industry number to the entire industry from the companies that you actually cover. So Perils does that by Cresta Zone and line of business, which allows to create these customized industry triggers that I mentioned earlier. And up until now, there have been 425 transactions with about 22 billion of insured limit being transacted on the Perils indices. The robustness of this process, how does it work? So there is a schedule. After each event, there's after 6 weeks, there's an initial reporting of data by the insurance companies, and then there's at predetermined intervals there's a second, third, and fourth basically data point that gets reported and then aggregated by Perils. That process is illustrated on the right-hand side. So all these data come in, they're being basically cleared of the company name. So these companies are no longer identifiable in the final product, and it gets then extrapolated to the market as a whole. And then as a last slide here, obviously for Perils Canada, which is CatIQ, here are basically the largest, 5 events adjusted for inflation. And as an industry index for Canada, this could be a type of trigger, basically basing it on these types of industry numbers. Yeah, I think that's it.
Great. So maybe Coker will now pull you in, and given the construction of cap bond structures, what is your view on the legal framework in general, but also from a Canada lens on ILS versus traditional reinsurance? And you have some slides, and you'll have some additional commentary in there.
Sure.
And please introduce yourself as well.
All right. So, morning, everyone. I'm Coker Christensen. I'm a partner with Fasken. And I've been working in the insurance sector there for about 20 years. So over that time, I've had an opportunity to work on many reinsurance transactions, and have had an interest in cap bonds and followed that. But of course, as we've heard, the Canadian cap bond market hasn't really developed the way it has outside Canada. So I'm going to talk about the legal and regulatory framework. And I'm going to start by talking about the framework for reinsurance, since there's obviously a very well-developed legal and regulatory framework for reinsurance in Canada. So some of the core concepts are up here, right? So it's about effective risk transfer. I'll come back to what that means in the context of cap bonds a little later on. And then there's the foundational concepts are the ideas of registered reinsurance and unregistered reinsurance. So registered reinsurance is if an insurer reinsures with a Canadian licensed reinsurer. So that's either a Canadian incorporated reinsurance company or a Canadian licensed branch of a foreign reinsurer that's acting in connection with its Canadian business. And so the basic concept here is that if you reinsure with a registered reinsurer, you get credit, you get capital credit for that as the ceding company. And the corollary, of course, is that you get capital relief as the ceding company. The reinsurer has capital obligations that it takes on. Now, unregistered reinsurance is reinsurance with someone that's not a registered reinsurer. So in other words, this is when you reinsure with someone that's not a Canadian licensed reinsurer, so offshore reinsurance. So the basic premise there is that you don't automatically get any kind of capital credit. There are certain techniques and tools that you can use to get capital credit, which basically involve making sure there's collateral in Canada. These are flagged up here, right? So the first one is a reinsurance security agreement. This involves the unregistered reinsurer posting collateral with the Canadian collateral agent and giving the ceding company a security interest over it. So that's basically securing the obligations under the reinsurance agreement. You can also use letters of credit from Canadian financial institutions, and funds withheld reinsurance will also allow for credit to be obtained. So that's the basic sort of framework for when you get credit or not, and that's set out in OSFI's capital guidelines. And so what I've listed on this slide is some of the key regulatory guidance relating to the reinsurance regime. And what I want to focus on is a couple things in here, right? And that's guideline B3 and B2. So the reinsurance framework in Canada has gotten a lot of attention over the last few years. There was a substantial review of the framework that was kicked off in 2018 by OSFI. They had a discussion paper. They came out with some proposals. There was engagement with industry, since some of those proposals were controversial and would have required certain companies to hold a lot more capital. And where they landed after that process was these revised versions of guideline B3 and B2 that are going to become effective in 2025. So I'm just going to sort of quickly touch on the key elements of those. So guideline B3, sound reinsurance practices and procedures, sets out expectations in terms of how insurers manage their reinsurance risks. So it talks about a couple things, right? So it talks about the need to have a reinsurance risk management policy that outlines the approach to reinsurance, addresses things like why are you seeking reinsurance, talks about ceding limits, concentration limits, counterparty risk. It also talks about due diligence, so expectations in terms of ongoing due diligence on reinsurance counterparties to make sure that you understand and are managing your counterparty risk. And it also talks about the terms of reinsurance agreements. So it talks about the need to have clear and comprehensive reinsurance agreements. And it also talks about the need to make sure that the provisions are not prejudicial to the ceding company. So this is where you'd see expectations relating to having an insolvency clause. It says that in the event that the ceding company is insolvent, the reinsurer has to keep making payments. So that's what B2 is about. That's a pretty foundational document in terms of reinsurance. B3 works together with B2 to kind of set out the risk management framework for reinsurance. So it has a couple of expectations that are relevant here. So one is that there's a gross underwriting limit policy, and that's supposed to be consistent with the insurer's risk appetite framework. It also sets out the expectation that insurers are going to establish a framework for figuring out what the maximum loss is on a single insurance exposure. So they have to be able to calculate that. And then the requirement is that they hold enough capital or assets to cover the maximum loss under their largest single insurance exposure. And that's on the assumption that their largest unregistered reinsurer in respect of that loss defaults. So that's the expectation in terms of the capital that's supposed to be maintained in relation to reinsurance. So that's reinsurance. So talking about cat bonds. So we talked about, we heard a minute ago about the different kinds of triggers, right? And so there was four basic types of triggers, right? There was indemnity triggers, industry index triggers, parametric triggers, and model loss triggers. So the first of those, indemnity triggers, that's basically reinsurance, right? That is to say that the trigger for whether the insurer gets paid under the cat bond arrangement is based on the losses that the insurer has suffered, right? So if you have a structure that involves an indemnity trigger, then the rules that I just talked about, those are going to apply. So if you want to understand whether you're going to get capital credit, then you look at whether you're dealing with an unregistered or a registered reinsurer, and if it's an unregistered reinsurer, whether one of those tools is being utilized to make sure you get credit. The other kinds of triggers are not indemnity triggers, and so they're not reinsurance in the same way. A key concept here is basis risk, right? Which is the risk that there's going to be a gap between the losses that the insurer suffers and the coverage that it gets from the cat bond structure. If it's an indemnity trigger, there shouldn't be basis risk. It should be directly correlated. But in the other with the other triggers, there can be a mismatch, right? And so it's not a perfect hedge. And so the basic rule under the Canadian regulatory regime is that that's not reinsurance. And so you're generally you're not automatically going to get capital credit for it. There is no specific regulatory regime for cat bonds other than the reinsurance regime, right? Subject to a comment I'm going to make in a minute, but there's no special provisions for the creation of these special purpose vehicles that we saw when we looked at the structure of cat bonds, and there's no particular regulatory regime for what kind of capital relief you'll get if you have a cat bond structure that doesn't involve an indemnity trigger, right? I think that's one of the reasons we haven't seen the market in Canada develop in the same way, because the regulatory regime doesn't really do anything to facilitate it, right? Depending on how it's structured, it can fit into the regulatory regime, but the regulatory regime has not been designed to provide for these. Now, I do want to highlight one feature of the regulatory regime that I think does create some space potentially for the emergence of cat bonds, and that's in relation to earthquake risk. So the MCT guideline says that OSFI expects insurers to be financially prepared for a 1 in 500 year earthquake event. And what that means is that they have to have adequate financial resources. So financial resources are defined to include a number of things in the MCT guidelines. So they include capital and surplus, earthquake premium reserve, reinsurance coverage, what we've been talking about, and then the last one is capital market financing. Capital market financing is defined in OSFI's earthquake guideline. And I'm just going to read how it's defined. It says, insurers can enter into innovative financing transactions designed to hedge their risk for a catastrophic event. In some cases, these are standby capital market financing facilities that become operative when a catastrophe occurs. Prior approval from OSFI is required before these instruments can be recognized as a financial resource under the MCT guidelines. So I think that language does open up space to potentially use cat bonds as a way of meeting the expectations to have financial resources in relation to earthquake risk. But of course, it's a bit vague, and it says subject to OSFI approval. Now, in discussions that I've had, or what I've heard OSFI say about cat bonds and ILS more generally, is that they're open to it. And I think these comments were made by the superintendent yesterday as well, right? So I think they are open to it. They are open to discussions about it, but that doesn't mean that it's going to be a straight path to achieving some particular outcome, right? It's going to be a bit of a process to make sure that OSFI understands what it is you're planning to do, that they understand how it works, what the risks are, and get comfortable with it. So all that is to say, if you can structure your cat bond so that it fits within the reinsurance construct, there's a regulatory regime for that. And if not, there isn't a particular regulatory regime for it. You can do it, to be clear, but you're not going to get the same kind of capital relief. You'll get, obviously, the financial benefits of having reduced your exposure to those risks, but you're not going to get the same kind of capital relief that you'd get from reinsurance. So I'll pause there.
Great. So I think all of that is hopefully helpful for you to understand the landscape of how these structures are created, and then how we could look to grow Canadian-sponsored cat bonds representation. There is one feature of the cat bond that we cannot compete with the traditional reinsurance market, and that's with respect to reinstatements. And that's mainly because you never asked your reinsurers to isolate $1 of their capital to only take on your risk. They're leveraging each dollar of capital and writing multiple risks against it. And you've gotten yourself comfortable because you're assuming that the rating agencies are holding down the casino bets that they're making across the different insurance risks, that they don't get over levered in a particular peril or risk or region, so that they will have adequate capital to pay. If the unlikely scenario happens where more than one of those segments goes beyond a catastrophic PML for that segment, they may not have the ability to pay. The difference in our structures is their ability to pay isn't questioned because you're 100% collateralized in a trust. But we can't compete and offer reinstatements because if you think about it from an investor's perspective, I'm negotiating a premium for the first primary limit. If I'm not going to get paid on the second limit, but you expect me to 100% collateralize a second limit, you're effectively saying, I will pay you half the return for 2 times the limit in their eyes, because it's inefficient in how they hold capital. So our structures don't offer the reinstatement. And do you feel that in OSFI's requirements or other regulatory requirements that reinstatements are one of the key barriers that have happened? And how do you feel about, in the very severe events, the value of a reinstatement? Meaning, I personally feel that reinstatements are very powerful on your working layers of your program where you're going to have frequency of activity. But when you get to the remote towers, the likelihood of triggering the reinstatement and then requiring reinstatements up so high in the tower, is that a barrier to this product in Canada? I'd love the perspectives of my panelists.
Yeah, well, I guess some thoughts there. So I think that is an important consideration, right? That, with reinsurance, you have automatic and paid reinstatement, and as you said, cat bonds trigger once, right? So that is a difference in terms of the kind of coverage that they're providing. I think that's one of the things that the regulators are going to want to understand. I don't think that's the fundamental barrier for why you're not getting credit for cat bonds that don't have these indemnity structures. I think the fundamental barrier is this concern about basis risk and whether there's effective risk transfer. But I do think if there are conversations around, how the regulator is going to view cat bonds, that the fact that it triggers once and it's limited, I think that's going to be definitely relevant, right? That being said, from a regulatory perspective, I think there are features of cat bonds that are attractive, right? So I think the fact that they are fully collateralized, I think that's pretty attractive. I mean, that's a core regulatory consideration, right? Is counterparty exposure, and that doesn't exist really in the same way in the context of cat bonds. I guess the other thing I would say is that if you just sort of think about the relationship between these sort of severe cat events that occur and cat bonds and the regulator's perspective, I think that the more that there is volatility, that the more that there are severe events, I do think that creates a possibility of opening up the cat bond market in Canada, and of regulators wanting to see that market opened up, right? I mean, I think that one of the reasons that the cat bond market hasn't really emerged in Canada in the same way is not just the regulatory considerations that I discussed, but is that there has been enough capacity in the reinsurance market to absorb risks, right? I think that there's been enough capital here. I think that the pricing's been acceptable, right? I think one of the questions, though, is, when you look at where we are right now and what we can expect in the future in terms of climate change, increasing severity of cats, increasing volatility, I think there's a question of, like, are those conditions that are going to limit the ability of the reinsurance market to provide coverage for these kinds of severe kind of tail risks that we're talking about? And I think they might. And I think that's kind of where the cat bond market came from in the first place, right? Is that when you had these severe events and there was a need for additional capacity. So I think that regulators, if they see that happening, they don't think that they'll sort of look at the fact that there's not reinstatements as something that should limit the desire to have a cat bond market emerge here. I think it'll actually be potentially a motivation to have that market emerge here.
Marcus, any thoughts from your side?
Yeah, no, I think you already mentioned that it's a little inconsistent, right, to require a reinstatement for a 1 in 100-year layer, which implied probability of that happening is 1 in 10,000 approximately, but then on a per event basis, you're not asking them to also purchase to the same kind of probability. So but you mentioned it's probably not that much of a constraint ultimately. There's also structural solutions around that, right? You could have an aggregate type cat bond that basically wraps around your traditional reinsurance coverage and provides some kind of second event protection as well. As if the regulator is open to, maybe some kind of probabilistic analysis of the overall structure and stressing it under different scenarios, those type of structures could potentially also help, create a solid overall kind of risk transfer structure.
Great. So maybe a last question, and then we'll open it up for questions from the audience. One of the myths I hear is, well, the capital markets are not relationship based, and I have relationships with my reinsurers. And we do actually respect those, because if you've had loss for years, you've built up a bank of premium income that you've paid to them and expect to be treated when your loss comes through in a reasonable fashion. What are your views on the relationships that you build with investors? Anecdotally, I think people have started to question the relationship having come through COVID and in the hardening of the market. All of a sudden, the relationship that you thought was good was a one-way relationship. When it's soft, they're there, but when it's challenging, or you've actually had a loss, but not unexpected for the type of event, it doesn't seem like there's as much of the relationship element. And so people think that within the capital markets, they're more litigious, or they no tears because they can walk away. But I would argue that I do think that there's definitely a relationship with the investors. But maybe, Marcus, you want to talk about it from your own experience.
Yeah, I think the market has evolved over time, right? In the very early stages of the market, 25 years ago or so, you had a lot of, really smart kind of quick acting capital come in, like hedge funds and so on, and they probably would be more, maybe inclined to try to kind of take advantage of a situation, maybe not pay whatever is due. But I think the market has evolved over time. First of all, there's a lot of disclosure in these transactions, right? They're set up so that they really act like reinsurance, and they have, instead of court resolution processes, they use arbitration and so on. So it's really, from a cedent's perspective, it looks a lot like reinsurance. It's fully disclosed to investors. Investors also get a lot of information about the portfolio. They typically get an analysis by a modeling firm telling them what this modeling firm thinks the probability is. They have access to other modeling firms' view of this risk. So there's a lot of transparency around it, which I think would make litigation difficult. Plus, two other points. So it's been many years, and there have been several pretty large events in the meantime, quakes in Japan, Hurricane Katrina, Hurricane Ian, and so on. I personally haven't been aware of that much litigation around it, actually probably not any. And the market, as Corey illustrated in her opening remarks, the market continues to jog along. New capacity, or the capacity continues to stay in. Seeding companies continue to issue more bonds, so it seems to be pretty stable. And furthermore, the investor universe has also morphed a little bit over time. I think nowadays it's probably dominated, and you correct me with your latest insights, but a lot of these investors are now basically specialized ILS funds. So all they do is invest in these types of structures, and they source their funds from underlying investors such as sovereign wealth funds, endowments, pension funds, and so on. And those investors themselves, they have a very long-term view. They're not like in it to come in 1 year and out the next. It's more like a strategic allocation to this sector. It's a very small allocation of their overall assets, so that they're not going to be that concerned if something happens to it, like a large hurricane and so on. But they take the long view, and these investors, they also manage pretty large portfolios. They're not interested in upsetting the relationship with sponsors. They actually rely on having access to product from all these different sponsors to continue investing their portfolios on an ongoing basis.
Great. And
Yeah, I guess I would just add, I think that from a legal perspective, I think there obviously is a difference between having an ongoing relationship with a reinsurer, right? I mean, you've got concepts in reinsurance like ex gratia payments, and so I think there are some differences. But at the end of the day, I think there's litigation risk in all kinds of transactions, right? I think that the key, obviously, is having the documentation be pretty tight, and I think that there's certainly in the reinsurance area, there's been a lot of development in the last few years in terms of expectations around what those agreements look like. But in the cat bond world, they're designed to be very clear in terms of when there's payout, right? So I mean, I think there are examples of litigation in both areas. Like, so for example, in reinsurance, it's relationship based, but if the losses are large enough, obviously people have to take a hard look at what their obligations are. And, for example, there was disputes around the Fort McMurray wildfires in terms of whether it was one loss event or multiple loss events. So you can have those kinds of issues. Obviously there hasn't been a lot of litigation around cat bonds in Canada, but, some of the disputes that I'm aware of, have to do with, if there's a report publisher that's publishing a report that defines the trigger for when there's a payout. If there's changes in how that's done, there have been disputes. So I think that there are some differences, but I think that there's always litigation risk.
Terrific. Well, I appreciate your comments. We have a couple minutes left if there's any questions from the audience. Terrific.
Thank you very much, guys. It's wonderful to see you all. Alex Corp. We just had a previous slide which indicated basis risk concept, and I feel it's my professional obligation to point out a finer point on that, lest people in the audience believe that basis risk is that bugbear that prevents cat bonds from being adopted by Canadian industry. Traditional indemnity insurance or reinsurance has plenty of basis risk. How? Because basis risk is the difference between your losses versus what you collect under the contract. In the traditional indemnity arrangements that we're all familiar with, it simply comes in the form of sublimits, coinsurance, deductibles, terms and conditions. So this is no different. And I wanted to kind of stress that point is, yes, I obviously have a dog in this fight, but cat bonds is a phenomenal tool. As Corey mentioned, Canada has been a participant in them through Canadian exposure being profiled in the North American cat bonds. I remember quite vividly the first such transaction 10 years ago by Allianz when they put BC quake exposure into the otherwise North American cat bonds, and there's been many other transactions since then. So that market is vital. It's going to continue to grow, but please don't let the basis risk bugbear deter you and think that this is something unique to that form of reinsurance arrangements. Thank you very much.
I think it's working now.
Okay. Hi, I'm Kim. Nice to meet you all. I had a question. I'm not an expert in this area, so if I misspeak, forgive me. But I know traditionally ILS is used for tail risk mostly, but through the last 2 renewal cycles, we've seen real challenges with retentions being raised, hard to place like traditional reinsurance aggregate covers because or for portfolios exposed to things like SCS risk. So Marcus, I think you started to touch on this. Have you seen anything interesting in ILS that helps kind of cover that gap at the bottom from the frequency perspective with ILS?
Yeah, I think certainly aggregate structures would help in that. They come in and out of favor a little bit, I guess, in terms of, I think the US also is facing similar issues in terms of the frequency, and if the market hardens, probably those structures are the first ones to kind of fall by the wayside. But maybe I'll defer to you also, Corey, on kind of what you've seen most recently.
Yeah, I mean, basically, if you can dream it up and model it, our community will consider it. Where they get concerned on the product is when the modeling doesn't match experience. And then they say, okay, I'm not pricing this off of the modeled view. I'm going to an actuarial analysis because of the frequency. And you see that with some, the U.S. insurer Allstate has an aggregate cover that's got a very low deductible. And so the performance is different from the model performance. So they're not just wedded to models. They do actually look at actuarial performance. But ag structures have been very prevalent in our market. And we just did a deal for Pacifica, which was a French insurer that basically was like a second or subsequent event type of structure that was managing kind of as the rising retention, taking some of the heat off of that, but maybe not on a first event basis, on a subsequent event basis. So there's definitely structures that we can look at to think about it, but you know, if you're hopeful that you only look at a model view or you're only going to look at your actuarial view, there's a blend of the two. There are many of the professionals that are underwriting these have the same type of experience as a traditional underwriter. So while you're getting their new lens of how to underwrite and capital coming from a fresh place, it's not like it's an alien landing and doing an underwriting process that's just completely foreign.
Thank you to Corey, Marcus, and Coker for that.